Hi everyone, this is Kiran Kumar. In this video, I am going to discuss about another important concept, that is additional performance measures. It means not only a ratios, cash flow statement and funds flow statement, even there are some additional tools or techniques can also use by the evaluator or investors for evaluating the company performance. These are all generally EBIT, earnings before interest and tax, and earnings before interest, tax, depreciation and amortization. These two values are also considered just for finding out the differences between the EBIT and EBITDA. Here the difference is depreciation and amortization, or regarding operating expenses. And another thing is net financial debt regarding the solvency. And one more additional performance is cash flows from operating activities. Why it is required to study along with the common reports means it helps the users of financial statements to evaluate an entity through the eyes of management and comparing the between the companies in the same sectors and stripping out elements that are not relevant to current or future year operating performance. So the main use of applying the additional performance measure is not only finding over about the liquidity, profitability, solvency and turnover ratios. There are some other important factors are also plays a important role, and those factors are highly required to evaluate the company performance. And this also will help a lot to the financial managers to take the decisions, maybe with regard to financial investment or dividend. And another one is these are also able to compare with previous years or current years. When a evaluator trying to compare with the previous years, then come to know the company performance, whether it is growing or declining. Then how it is possible means when the reports are prepared in a same standard manner or same standard profile. Now coming to the drawbacks or disadvantages of presenting additional performance measures is an entity might calculate an APM in different way year on year. That means whatever they apply last year, that may not be possible to apply the same method in the next coming year. Second one, two entities might calculate the same APM in different way. Actually, to calculate a EBDIT and EBDITDA may be the different, or else calculation of EBIT, EBTDA may be the different, or the calculation of EBIT, EBTDA may be the different. Why? Because some companies follow the different method for calculating the depreciation. Why? Because there are different depreciation methods are there, like straight line method, diminishing balance method, weighted average method. So one company may apply the straight line method and another company may apply the diminishing balance method. With regard to this, it may affect on profits. That is what APM point of view, it is very difficult to apply the same method. Next, another one. Entities often provide little information about how an APM is calculated, and it reconciles with the figures presented in the financial statements. So whatever they disclose with regard to the additional performance measures, they may not provide full information. Why? Because there may be some errors or else the information may not be relevant, and it might be selected and calculated to present an overly optimistic picture of an entity performance. Some companies choose these additional performance to show their optimistic entity's performance. Too much information can be confusing to users of the financial statement. In case if they provide the additional information along with the annual reports, sometimes investors may get some confusions. And giving an APM undue prominence may mislead users of the financial statement into believing it is a requirement of IFRS standards. So undue prominence may mislead the financial statements of the company. Thank you very much for watching my video.